Hello everyone, just checking if I'm audible and visible. I will wait for someone to confirm on the chat box, and probably in the next minute and a half we should get started. Just checking if we are live yet. I will wait for someone to confirm. Please let me know if I'm audible and visible. Sounds good. Looks like we are audible and visible, and we are live. So hello everyone, first of all welcome to this FM revision for the ACCA exams. And at the outset, to start with, while I'm assuming some of you would have joined this knowing who I am, but for those who are new to this channel, for those who are seeing this video for the first time, just a quick brief introduction about myself before we get started. I am CA Divesh Harpalani, a chartered accountant, an Indian chartered accountant, fortunate to have secured an All India rank 6 and an All India rank 13 in CA. I have close to 5 years of work experience across private equity and management consulting. I did my articleship at Deloitte, and also I've had the fortune to have mentored more than 1,000 students as well as freshly qualified professionals. So that's a brief about me. About this revision of the financial management ACCA course. This basically will be a 3-day marathon starting today. Of course, towards the end of this video, we'll confirm the time for tomorrow as well. And just before actually we go into the specifics, this is the overview of the ACCA Financial Management Skill Level course, where we have about 7 core sections, Section A to Section G. And the most important, of course, as I keep telling my students, Section B, or rather I would say Section D and Section G are absolutely the most important from an exam perspective, which is investment appraisal and risk management. Not to say the other sections are not important, but these two are absolutely important, especially from the perspective of Section C in the examination, which is constructed response questions. So these two are the most important sections, and which is why from a revision perspective also, when we start, we will be covering these 2 sections first, and then depending on the timing we will we will decide which other sections and what depth can we end up covering. So about the revision, just a brief before we get started. This revision will be excuse me, I'm slightly not keeping well, so kindly excuse me for the mini breaks in between. But having said that, coming back, the point was, please expect this revision to be focused mainly on concepts. We will also be looking at examples and questions here and there, but it will be fully focused on concept. This is absolutely exam oriented, where the intent is to cover maximum in minimum time, so that your exams, which is less than a week away from now, if you're a March 26 student, you can cover maximum in a minimal time, and you can really jog your memory, refresh your concepts. But having said that, the only thing that I will tell you is, the one thing that is a precursor is, I will not be teaching concepts to you from scratch, but I will much rather help you jog your memory, refresh all your concepts. So if you've at least read the chapters once, if you at least know the concepts basics, it will be much easier for you to relate with me. Remember, this is a revision and not a fresh course, and hence it may be difficult for you if you've not ever read. So the recommendation is, if you've at least read once, and then if you're watching this, then it'll be the best. So let's quickly dive into the content. The first chapter that we start today, the first section that we start today, is going to be the investment appraisal section, which like I said is going to be one of the most important from an exam perspective. I will be using my own notes, which is a relatively more summary version as compared to the study hub or the Kaplan or the BPP, and This, by the way, will be, while it is a summarized version, it is absolutely exhaustive, and we will be covering all the concepts today in the required length and detail. Okay, so let's just get started very quickly with the excuse me, with the concept of investment appraisals. So for those of you who've studied the course once would know that there are three main decisions. And by the way, something that I keep telling all my students, all whether they've taken the lectures or watched my YouTube videos while studying with me, I will excuse me, just give me a moment. The one thing that I will tell you is for you to always keep wearing that hat of the future CFO of a multi-billion-dollar company is something that I will definitely suggest and recommend you to do. Why that helps you is, one, to step into the shoes of that CFO and understand the concepts better, but not just that, you actually in the examination hall also have to act as a future CFO and have to answer the questions in such a manner, because remember, there are 20 marks out of those 100 marks which are solely for your professional judgment, for your professional skills, for how you are able to answer and not just give the answer in terms of maths. I keep telling my students that financial management is not calculator, but it is a life skill. It is absolutely an integral part of the daily lives, and especially for someone who's a future budding finance professional, it is absolutely important. So if you've studied chapter 1, which is the role of a financial manager, you would know that there are three core functions of a financial manager. And just think of it as you yourself, right? What are your life goals? First of all, you might think, oh, how do I earn? So you would want to take a job and you would want to decide where to get money from, which is called as the financing decision when you are a CFO. Once you start earning money, you decide where to spend, where to invest, which is the investment decision from a CFO perspective as well as an individual perspective. And number 3 is once you've earned money, once you've started saving, that is when the question comes as to how do I put in the money which I have already invested. If I'm getting returns, what do I do? Should I reinvest that money or should I spend that money? What should I do? Which is, in the eyes of the CFO, it is called as the dividend decision, which is basically whether to what to do with the funds that you would have earned. Should you return the funds to the shareholders in the form of a dividend, or should you reinvest those funds into new projects which will make you more money? All the three will lead to individual chapters in themselves, but the most important, like I said, from an exam perspective as well as for the real life of a business, how do you invest and make money? That, if it in fact is the investment decision, which is all about the chapters that we will be going to cover today. Okay, so without further ado, let's just get started. What is investment appraisal? You deciding which investment to make. If you are an individual, you might decide whether to invest in a mutual fund or invest in gold or invest in a fixed deposit in a bank or maybe buy real estate. Similarly, from perspective of business also, between different projects that are available which can make them money, which project to invest in. Deciding, this process where they decide which project to invest in is called as appraising the investment, evaluating the investment, and hence this becomes an absolutely critical stage in the capital budgeting process, where you decide how much funds do you want to invest, how much will you earn out of a project, and hence whether you should invest in a particular project or not. So your expected returns versus how much you'll have to invest, and over the project's life, how much will you keep investing and how much will you keep earning as the return. Okay. What is capital investment though? Capital investment is defined as the spending that you do on non-current assets. For those of you who already studied FR or have done graduation would know what is the meaning of non-current assets. Some assets that are more long-term in nature, that are helping you to earn future revenue. These capital investments form part of the capital budget. This chapter, which is chapter 2, which talks about the basic investment appraisal techniques, covered two main techniques. See, there are a lot of techniques, and those of you who studied the course would know there is NPV, there is IRR, there is discounted payback period, there is ROCE, there is payback period, but we'll be starting with the two simplest ones right now. And by the way, feel free to stop me at any time if you have any queries. Put your queries in the chat box. I have it over here, and if I have any queries, I will definitely answer those right away. So the two methods that we'll be addressing in this chapter are return on capital employed as well as the payback period method. So what is the return on capital employed? As the name suggests, it talks about the return that you will be earning out of the investment that you've made, the capital that you've invested. Sir, what is the return that we're talking about over here? Excuse me. Excuse me. This return is nothing but the accounting return. Sir, what is the accounting return? Accounting return means the profits that you earn that are shown in your P&L. Those are the accounting returns. Excuse me. So the return on capital employed hence is also known as the accounting rate of return, which measures what? It says if the project, let's say, is for 7 years. Over a period of 7 years, what is the average return that you will earn? That average return versus how much will you invest to earn those average returns. So the average annual profits, but remember, this is going to be before interest and tax. So this is nothing but EBIT, or you can also say PBIT, which is profit before interest and tax, or EBIT, which is earnings before interest and tax, divided by the initial capital cost. What is the initial capital cost? The amount that you will be investing in the beginning versus the returns that you will be earning on a year-to-year basis. That is what this ROCE will tell you about. Okay, initial capital cost. So the capital that you've invested. There is a second formula also. There's a second method also. See, one can argue. I will say, sir, I invested 1 lakh on day one. I invested 100,000 on day one. But what if at the end of this project, I'm able to sell the machinery? Let's say the entire 100,000 was investment in a machinery, but at the end of the project, I can sell it for 20,000. Have I invested 100,000 or have I invested 100,000 minus 20,000? So yes, my net investment actually was what? That investment was not 100,000, but it was an average. It was an average of 100,000 and the 20,000 that I will get back. So my average investment was 60,000 because if I'm looking at average profits, I should also look at the average investment that I'm making. And hence the second formula is the average annual profit divided by the average investment, where average investment is calculated as the initial cost plus scrap value. So in my example, 100,000 plus 20,000 divided by 2, which means 120,000 divided by 2, which is 60,000. So average annual profits divided by average investment. And what is ROCE? ROCE, remember, is a percentage answer that you get. So if your annual profits were going to be 6,000, then 6,000 divided by 60,000, you end up making 10% return on your capital every year. Method 2 is exam favorite. Generally, exam will always specify that you have to calculate it on an average investment basis. But in the event where, let's say, hypothetically, the exam does not specify if it is on an average investment basis or initial investment basis, always go for formula 1. But in 99% of the cases, the exam will specify that you have to use the average investment formula. So that is the exam tip that is mentioned over here, and such tips are mentioned throughout the notes so that it becomes easier for you. Now, sir, what is the meaning of the initial capital cost? Initial capital cost, of course, if you're buying a new asset, something as simple as the cost of the new assets that you have bought. But sir, what if I'm using an existing machinery for a new project? Then in that case, you use the book value of the existing assets. Sir, what if along with the investment in the machinery, I have to also invest money in working capital? Then in that case, there is also the working capital investment that you will have to add. And lastly, if there is any R&D which you are capitalizing, if any research and development expenditure that you're capitalizing, that also you will add. Now, how do you decide? See, what is the eventual goal in this chapter? The eventual goal is to evaluate, to appraise the investments, to evaluate the investments and decide whether you should make the investment or not. And hence, that decision will be taken how? If you have decided as the CFO that I will invest only in those projects which generate more than 10% return, and this project generates 12% return on capital employed, then you invest. But if it generates 8% return on capital employed, then you decide not to invest. So the acceptance or rejection will depend on whether your estimated ROCE is greater than the target or the hurdle rate which you as the CFO or you as the management, future CFO, will decide. And remember, in the examination, you just don't need to write whether you should accept it or not, but you also need to specify. Even if in the question it does not mention, the target rate, you should absolutely mention that you should accept the project only if it exceeds the target hurdle rate. There will be 1 or 2 marks for the conclusion as well. Quickly, couple of examples. We are not solving it here, but I will tell you how to solve it. Project involves immediate purchase of a plant costing 1,10,000. This is your initial cost. Annual cash flows will be 24,400. So this is your annual profit. This is cash flows, but then nothing else is given in the question, so you can assume it to be the profits as well. And scrap value is given. So using initial capital cost, it is nothing but 24,400 divided by 110,000. And if it was to be average investment method, what will you do? You will take the average of 110,000 and the scrap value of 10,000. So 60,000 will be the average and numerator will be 24,400. So 24,400 divided by 60,000 will be your return on capital employed as per the average investment method. Example 2, very quickly. Initial investment 800,000 which is given, and scrap value 100,000. So in method 1, your denominator will be initial cost, which is 800,000. In method 2, where you take the average investment cost, what is your average investment cost? Your initial investment, which is 800,000, plus your scrap value, which is 100,000, divided by 2. So 900,000 divided by 2, which is 450,000 will be your denominator. This is your average investment. Now, what is your numerator? In both the formula, remember the numerator is absolutely the same. What is the numerator? Average annual profits. Do not forget the word average. So if you are given the total cash flows for a period of 7 years, do not forget to find out the average. But sir, these are cash flows. I need to find out profits. Now remember the formula of profit. While we'll come to the discussion of cash flow and profits in detail, what is the formula? Cash flows is equal to profit plus depreciation. Sir, why? Excuse me. Excuse me. See, depreciation, if you remember, is a non-cash expense. So while from a profit calculation perspective, you would have deducted depreciation in your P&L. You would have already deducted depreciation as an expense. But will that have been considered in the cash flow? Absolutely yes, because depreciation is a non-cash expense, and hence when you find out cash flow from profit, you will have to add the depreciation back, because you've already reduced the depreciation while calculating profit. You'll have to add it back while calculating the cash flows. And hence in both of these examples, what you've been given is actually annual cash flows. Annual cash flows, you would have to find out annual profits. So if cash flows is profits plus depreciation, then annual profits is nothing but cash flows minus depreciation, which is how much your business has generated in cash, minus depreciation, which is a non-cash expense. I know all of you know how to calculate the depreciation. Over here it will be 800,000 as cost, minus 100,000 as scrap value, divided by the number of years, which is 7 years over here. So 100,000 will be your average annual depreciation. So you find out the average cash flows and then you reduce average depreciation. Alternatively, you total all the cash flows of 7 years and then you reduce the amount of depreciation from that, and then find out the average. That can be used as a numerator. Okay. Now see, in exam, what can happen is you will be given some of these questions where you also have to calculate, not just you have to calculate the return on capital employed, but in a 20 mark section C question, or sometimes in section A and section B questions also, which are objective type questions, you can be expected to be tested on the theory points. Now sir, what theory? The theory will be, let's say, what is the advantage of ROCE? For an objective question perspective, you will be given 4 points, and then one of the points will be, what is not an advantage of ROCE? There will be 3 advantages that will be given, and there will be 1 disadvantage that will be given, and you will have to identify which is not an advantage of ROCE. Which means you will have to understand first of all what is asked in the question. What is asked in the question? What is not an advantage? So you have to first of all read the question correctly, and then you have to read all the 4 points carefully and be able to answer. And hence theory is equally important from an exam perspective. While you don't have to mug it up, you have to obviously understand. So what are the advantages and disadvantages of ROCE? You logically think, is it simple? Absolutely, it is simple. Is it easy to understand? It is easy to understand. Is it directly connected with your accounting? Yes, because you use your P&L profits. Remember, you can also use return on capital employed to compare between companies. Oh, if I'm comparing, let's say, Hindustan Unilever, which is an FMCG company, with Britannia, which is another FMCG company, can I compare the return on capital employed or two? Absolutely yes. So it is simple, it links with other accounting measures, and it is easy to compare. But what is the problem? The problem is it uses accounting profits, it does not use cash flows. And I keep telling my students that profits are something that can be manipulated. Profits are opinions. Profits are opinions. But cash flows are facts. You can make a lot of credit sales. You can keep making credit sales and increase your profits. But what if you never get back that money? Then in that case, you don't have cash flow. A lot of businesses close down, not because they are not profitable, but they close down because they don't have enough cash. So the problem is it ignores cash flow. Profitability is subjective, it can be manipulated. Plus it ignores the timing of the cash flows. Whether you receive the cash flow in first year or you receive all the profit in the 7th year, it doesn't matter, because you will consider only average profit. Now average means total divided by number of years. Even if you received the entire amount in last year, it's okay. But then you will ideally as an investor want to keep making profits every year, right? And hence timing is important. Plus when you want to compare two projects, one project is of 2 years, another project is of 10 years. How do you compare the two projects? Let's say the project of 1 year gives you a 20% return. The 10-year project gives you 15% return. You will say, sir, I should go with the 20% project. But with the 20% project, you will invest your money only for 1 year, but the 15% you will be investing for 10 years. So what is better? The 10-year project is better because that gives you a more long-term investment opportunity, and hence project length is important, but ROCE ignores the project length. It may also ignore the working capital. It is always not explicit, but you as a good CFO, if in the question the working capital is given, you should absolutely consider the working capital in the capital investment. It is not a measure of absolute gain. So I'll give you one example. There are two friends. One friend says, I have earned 100% return. Another friend says, I have earned 10% return. And then you say, okay, I will go with the 100% return friend. He's so much more smarter. He says, I've earned 100% return on $100 of investment. And the friend says, I've earned 10% return on $100,000. What is better? This gentleman would have earned the $100, which is absolute number, and this gentleman would have earned $10,000. Now what is better? Absolutely, friend B is better. So the problem with return on capital employed is it ignores the quantum. It only focuses on the percentage gain, and they will go for a large ROCE in decision making, but large ROCE in decision making on a small investment is not as important as smaller ROCE on a large investment, which is our friend B. Now, this also does not end up giving a definitive investment signal. If I was to tell you, is 12% return good? Some of you might say yes, some of you might say no. What is the right answer? It depends on the management. If a management wants 15% return, 12% being lesser, 12% will be rejected. But another management, they want 10% return, 12% will be accepted, and hence there is no objectivity. This is absolutely subjective. So these are the advantages and disadvantages of ROCE. What are the key differences between accounting profits and cash flows? This is also an important topic. Yes, from an exam perspective, but also from a practical understanding perspective. Ask why. Again, like I said, profits can be manipulated. I can keep making credit sales but not receive the cash flow. So, sir, what should I do? You should ideally appraise the investment, evaluate the investments on the basis of cash flows and not profits. Remember, this was one of the disadvantages over here of ROCE, that it is using profit and not cash flows. One more important tip I can give you is, it is only ROCE method that makes use of profits. Every other investment appraisal method makes use of cash flows. Why do we prefer cash flows? Why? Because profits cannot be spent. You need money to spend. You need cash in your bank account to spend. Profits are subjective. Why? Depreciation method could be very different. Inventory valuation method could be very different, and plus profits can be manipulated. If you have to pay dividend to your shareholders, will you pay dividend to your shareholders using profit or using the cash that you have in bank account? Absolutely, sir. I need cash in my bank account to pay dividend. And finally, wealth transfer. Dividends are the ultimate method to transferring wealth to the owners, and I can do so only with cash. So then how do I find out cash flow from profits? I've already told you partially, but the key differences are depreciation, of course, non-cash expense. So while calculating profit, you would have already reduced depreciation, which you will have to add back. Next will also be working capital changes. So working capital is not considered in profits, but it is considered in cash flows. So you'll have to consider that. If you've bought an asset or sold an asset, is it considered in profit? No, sir, it goes to the balance sheet. And hence, while it goes to the balance sheet, it will still affect your bank balance. Just ask yourself the question, does the expense affect the balance sheet or not? Just ask yourself, does an expense or does a cash flow affect P&L? Does depreciation affect your P&L? The answer is yes. Does it affect your bank balance? The answer is no. Does an asset purchase affect your P&L? The answer is no, because it goes to the balance sheet. Does it affect your bank balance? The answer is you will have to pay from the bank balance. That is the key difference, that is the key difference between profits as well as cash flows. Deferred taxation. What if tax expense is booked today, but you are not actually paying tax today? And finally, capitalized R&D, which I told you earlier as well. You spent R&D, but you've not booked it as an expense in the P&L. You have capitalized it in the balance sheet. So cash flow is accounting profit plus depreciation plus any other non-cash adjustments. Now, are all cash flow are all cash flows important from an investment appraisal perspective? The answer is no. Think for a moment why. Before I give you the answer, let me give you one trick, or let me give you one example, a funny example. Let's say if you are going to take your boyfriend or girlfriend, as the case may be, for a date, and your intent is that you will end up proposing him or her. And the dinner, by the way, is prepaid. You are going to go for a dinner, candlelight dinner, you are going to propose them. The dinner is prepaid. And hence, whether him or her tells you yes, or very unfortunately that gives the answer as no, you have to spend for the dinner. So, is the decision of spending on the dinner going to change by the yes or the no? The answer is no. In which case, Does it matter that cost matter? The cost does not matter, because even if there is a no, you will have to spend the cost. So that expense is indifferent. It will either way stay, which by the way is called as sunk cost, a cost that is already incurred, cannot be recovered. Let me give you another example. You want to buy a machinery. For buying the machinery, you've done some market research of whether this machinery is good or not. You have invested, let's say, $10,000 for evaluating whether you should buy that machinery or not. Now, even if the answer is no or the answer is yes, you would have anyway spent that $10,000, which you'll never recover. So then it becomes irrelevant from a decision making perspective. Your decision of whether to invest or not should be solely based on what are the incremental cash flows that you'll be incurring today onwards, and something that will change basis your decision of whether you want to invest or not. Let me give you another example. Let's say you already have a supervisor. Even if you add one more machinery, he's already looking at 5 machineries. And if you add one more machinery, he will look at 6 machineries. But your payment to the supervisor does not change because of the 6th machinery, because your payment to him is not changing because of the 6th machinery. It doesn't matter even if he will spend some time looking at the 6th machinery, because this cost is going to be incurred any which ways. It is a committed cost, so it is irrelevant to your decision making. But now if you want to decide, should I employ a new supervisor, that decision absolutely will make a difference, because it is an incremental cash flow. It will arise only and only if the project goes ahead. It is future, something that will be invested now on. So future costs, future opportunity, future cost, incremental cost, as well as cash based or opportunity cost, which is, let's say, if you would not, for example, let's say you have taken, hypothetically, there is a machinery that you already have in your balance sheet. You are not going to buy a new balance sheet, not buy a new machinery. Now, this machinery, you will say, sir, I am not incrementally incurring that. I anyways have it with me and I am using it. But if you would have not used it for this project, you could have sold it. Sir, if I would have sold it, I would have gotten 30,000, which I will not get now. And hence that 30,000, which you would have otherwise gotten by selling that machinery, but now you will not get because you are using it in the new project, that becomes your opportunity cost. And hence you will have to consider that in your decision making. So these are relevant costs that you have to consider for a decision making. So what is irrelevant, sir? What is irrelevant is something that is sunk cost. My example that related to dating. Something that is committed cost. Non-cash items. Of course, I told you depreciation, for example, is not a cash flow, but it is an accounting profit. And allocated or absorbed overheads. An example is you as the future CFO will also devote time to the new project, but you would have either ways gotten that salary, right? This supervisor, for example, would have either ways gotten the salary. It does not increase because of that project. And even if the question says a part of the supervisor's salary, 1/6 of the supervisor's salary gets allocated to the machinery, it does not matter. Why? Because it was either ways going to be spent. It is not incremental. It is just an allocation of overheads. And hence you have to ignore these cash flows. These are not relevant. So then, sir, what should we include? You should include direct revenues from the project, direct cost, any opportunity cost, and any incremental cost, which by the way are a direct consequences. You just ask yourself the simple question: if I am undertaking this project, will this cost be incurred? Will I get this revenue or not? And if your answer is no, it doesn't matter. Even if I am not undertaking the project, I will going to incur this cost, then that is a not relevant cost. Let us look at one of the 3 examples. The first one, a manufacturing company considers producing a new type of widgets. Every widget requires 2 hours to make. Fixed costs are apportioned. As you can see, apportioned, allocation, absorbed on the basis of 1 per labor hour. Does it matter? No, sir. These are fixed costs. You would have either way spent because these are fixed costs. So you should ignore the fixed cost. If new widgets are produced, the company will have to employ an additional supervisor. Is this an incremental cost? Yes, sir, there is an additional supervisor. It is a direct consequences. If I undertake this project, then I need a new supervisor at 15,000, and hence this will be a relevant cost. But the fixed overheads is not going to be a relevant cost. Let us look at example 5. A machinery purchased 7 years ago at 80,000, estimated 10 year, is idle and would be scrapped for 5,000. My example, what is your opportunity cost? Opportunity cost is 5,000. And hence original cost and accumulated depreciation are not relevant. They are sunk costs. So should I not look at book value? My book value is 80,000 minus 56,000. My book value is 24,000. Is the opportunity cost 24,000? No, sir, that is just book value. The point is, if I was to sell it in the market, what would I have gotten? How much bank balance would have changed? My bank balance that would have changed would have been 5,000, and hence the cost would be 5,000. But having said that, if it is used in the project, it has no residual value and the disposal costs are 1,500. Are these disposal costs incremental? Yes, sir, because it is only if I use, otherwise there are no disposal costs. So my opportunity cost is 5,000, but my incremental disposal costs are 1,500. So my total costs are 6,500. That is how we go with the concept of relevant costs. You can just quickly read the decision framework as to how do you decide if a cost is a relevant cost or not. Which cost do you take into account? Quickly to the next method of payback period. See, the payback period is, as the name suggests, by the way, this is the second method. So, by the way, there are two basic investment appraisal methods, and both of these methods do not consider the concept of time value of money. Time value of money is what? The value of $1 today is more than the value of $1 tomorrow. That is the concept of time value of money. Both of these methods do not consider the concept of time value of money. And ROCE does not consider the concept of cash flows. It only considers the concept of profit. So this is what you should remember. What is the meaning of payback period? As the name suggests, payback. If I am paying for a project or investment in a project, in how much time will I get payment back? In what time period will I get the return, the same amount that I've invested, in what time period will I get that amount back, is something that payback periods tells you. It is a time that a project takes to pay back, recover the initial money that is spent on it. Okay, so how do you decide whether to invest or not? You will say, sir, what is the management's criteria in terms of when do they want to get back their get back their money? Let's say if a management says, I want to get back the money in 3 years, then 3 years is your criteria. And if your payback period is 2.5 years, 2 years, 11 months, then you undertake the project. Or if you get back your money in 3.5 years, then you do not undertake the project. As simple as that. If you have two options, then what do? There are two options. One project gives you money back in 2 years. One project gives you money back in 2.5 years. You can accept both. But if I have to make a choice between the two, which one should I accept? I will of course accept the one where I get back the money sooner, where I am able to recover the money sooner. So I will go with the one which will give me the money back in 2 years. So between options, choose the one with the fastest payback. So how to calculate payback? Very simple. Let's assume you are investing 100,000 today. Your annual cash flows are going to be 25,000 over the next 8 years. So how much do you have to recover? You have to recover only 100,000. So in what time period do you recover 100,000 if every year you recover 25,000? It will take you 4 years to recover this number. So initial investment divided by annual cash flow is your formula to find out the payback period. But what if, sir, in 1 year I am which is uneven cash flows. In 1 year I am recovering 25, another year I am recovering 10, third year I am recovering 50, fourth year I am recovering 30, fifth year I am recovering 50 again, and so on and so forth. Then how do I calculate? I will have to manually calculate in how many years am I getting back the money. First year 25, next year 10, so total 35 I have recovered in 2 years. Next year 50, so in 3 years I have recovered 85,000. Now I had invested 100,000, I have already recovered 85,000. How much more I have to recover? I have to recover 15,000. Out of, in fourth year I am making a total of 30,000, which means I will need only half a year, half of the fourth year, and full of 3 years I will need 3.5 years to recover the entire investment. So it is 3.5 years of payback period. What do I have to do? I have to accumulate the cash flows of every year, and then I have to see what is the difference between the amount that I have recovered versus the amount that I should have recovered, and that difference, which is 15,000 in our example, so the outstanding amount divided by the total cash flows in the immediately next year. So 15,000 divided by 30,000, that will be the incremental number of years beyond these number of years. So number of months is, by the way, payback effectively occurs when cumulative becomes positive. At the end of this year, if I was to add 30k to 85k, then it is going to be 115,000, which is more than 100,000. So my payback occurs in the fourth year. But is it 4 years? No, it is 3.5 years. So how many months? Outstanding amount at year start, which is 15k in our example. Year's cash flow, what is the total year cash flow? 30,000 into 12 months, which means this is 6 months. And remember, always round up. If this was 5.4 months or this was 5.6 months, even then I would have rounded up to, do not round down. 5.4 ideally you would have wanted to round down, but never round it down. Always round it up. Always go for 6 months, as in round off, as the case may be. It is 7.5, go for 8 months. So let's take this example. I'm not getting into the full math, but how do you do the math? You will say, okay, 1900 I've recovered 300, so now 1600 is pending. I've recovered another 500, so now 1100 is pending. I've recovered another 600, so 500 is pending. Now 500 I have to recover, but I am recovering 800 in the fourth year. So 500 divided by 800, whatever the answer is, you have to round it off upwards. Plus you have to add 3 years. So 3 years plus whatever number of months. Hypothetically, this is, let's say, 8 number of months, let's say, or 7 number of months. I think it will be 7, whatever. So you will say the answer is 3 years and 7 months or 3 years and 8 months. The key notes are negative cumulative indicates recovery is incomplete, which means till here it was excuse me, negative, so my recovery was incomplete. But over here it was positive. Why? Over here it becomes positive 300, so my recovery is achieved. Fraction is outstanding divided by the year's cash flow, which is 500 divided by 800. Always round up, do not forget, common mistake that most people make. And assume even distribution through the year, because some of you might say, sir, what if I'm receiving the 800 in the last month? Doesn't matter. You have to always assume that equal amount is received in every month. So what are the advantages and disadvantages of payback? All the investment appraisal methods will have their own set of advantages and disadvantages, but they are very intuitive. Like I told you, see again, excuse me. What is the title of the chapter? The title of the chapter itself is Basic Investment Appraisal Techniques, because these are basics. They are very simple to calculate. They talk about when will I recover my money. Let's say if you are investing in a plant, investing in a machinery which has a changing technology, where you know that there is a risk. What if technology changes and machinery is no longer useful? You would want to recover your money as soon as possible to lower the risk, and hence one of the advantages is simplicity. One of the advantages is rapidly changing technology. What if you say, okay, today the business environment is not so good, but it is going to improve in a certain point of time. You will say, okay, let me invest in a project which gives me the payback of those funds that I've invested very quickly, so that I can reinvest in better opportunities when the investment conditions improve. Excuse me. And finally, it favors quick return projects. Let's say if a company is growing very rapidly, it is helpful. It helps you minimize the risk. An example I can give you is, if one friend tells you, I will give you your money back in 1 day, another friend tells you, I will give you your money back in 1 year, what will you prefer? You will prefer 1 day because the risk is lower, and maximizes liquidity because it talks about how soon will you get back your money. Another advantage versus ROCE, remember in ROCE the disadvantage was it used profit, which is subjective, but in payback period we are using cash flows. Then sir, what is the disadvantage? Think about it for a moment. The disadvantage is it absolutely ignores time value of money, something that I told you is true for both ROCE as well as payback period, something that is true for both of these, which is it absolutely ignores the concept of time value of money. And whether you receive the funds in year 1 or year 4, it is absolutely the same as long as you are able to recover the money. It does not tell you when do you recover within those 4 years. Second issue is one project will recover money in 1 year, another project will recover money in 10 years. But the one project that recovers money in 1 year does not generate any profit. It just recovers only the investment. The one that recovers in 10 years will generate double the amount in the 11th year. Then what do? Ideally, you should go for this project, but according to the payback period, it will show that you should go for the project with 1 year life cycle. So ignores post payback cash flows. It ignores that fact that in 11th year you are making profit. It ignores timing within the payback period, whether you are getting cash flows in year 1 or year 10. It is ignoring. Same problem as you had in ROCE. Lack of objectivity. Why? Again, same problem. Is 3 years a right period, or 2 years, or 1 year, or 1 month, or 10 years to get back your money? Again, it is lacking objectivity. It ignores profitability. See, ROCE will still consider profitability, but over here it will consider only and only the recovery of your money. It doesn't matter if the project makes profit or not. What if it is not making profit? It doesn't matter as long as it is recovering the capital. And finally, it is very, very subjective. Okay, so that's it with this chapter. Let us quickly move to the next chapter, but in the meantime, you can quickly, we'll take a 30-second break and you can quickly read the chapter summary and exam tips. This especially is very, very important, the exam tips. Okay, hoping you've read. If not, just pause and read. But let us move ahead in the interest of time. Also projecting this screen, you can take a screenshot, or you can just pause and read, but in the interest of time, just quickly moving ahead. On to the next chapter, which is advanced investment appraisal techniques. These were basic techniques, but now we will go for those techniques that involve time value of money. Remember, the first technique did not consider time value of money, but the second technique needs to consider time value of money. Now, second category of techniques, I would say. What is time value of money, sir? In simplest words, the value of $1 today, the value of 1 rupee today is more than the value of 1 rupee tomorrow. Think about it this way. If you were to give me 100,000 or 1 lakh today, tomorrow, will you expect from me that I give you more money, or will you expect from me that I give you the same amount of money? Of course, you will say, sir, you've used the money that I've given for over a year. Probably you've invested somewhere and you've made some profit. I want you to give me more money that I had invested, I had given to you. That would have been the criteria for you, correct? And hence, you will say the fundamental principle is money received today is worth more than the same amount received tomorrow. Why? There are 3 reasons. First of all, there is a potential of earning money. If you have the money today, you can invest in somewhere and earn some return. So number one is that. And hence the value of 1 rupee today is more than the value of 1 rupee tomorrow, because 1 rupee tomorrow will become 1.1 or 1.2. Number two, you also have an inflation. There's a fun fact. I had done some quick research. 1950s, tea was available at 7 paise. The same tea that even at a tea stall today is 10 rupees, it was available at 7 paise. Just imagine the amount of inflation. And finally, every investment carries risk. So if you are making an investment, you would want to be compensated for the risk. You will say, if I'm taking a risk, please give me higher amount of money tomorrow. And hence, because of these three reasons, potential for earning interest, impact of inflation, and risk, these are the three reasons why time value of money is important. And hence, discounted cash flow techniques, which is those that we'll be studying in this chapter, are going to account for all the three factors, which is interest, inflation, and risk. And this rate, discounting rate of return, or rather discounting rate, is called as cost of capital, or the required return, the rate which you will want to understand or want to earn on a particular investment. Now, if I tell you that your 100 rupees today or $100 today are going to increase by 10% year on year for next 2 years, okay, so we are standing at year 0, which is today. You invest 100 today. What will that number be in year 2? That number, if you increase by 10% in year 1, it will be 110, and the same 10% in year 2 will be 121. Why? Because now you will be earning 110 into 10%, you will be earning 11 on top of the 110, so total of 121. This concept where 100 becomes 121 tomorrow, this concept is called compounding, because your money keeps compounding, it keeps increasing. Okay, so what is 100 over here? 100 is nothing but present value. What is 121 over here? 121 is nothing but future value. What was the rate for us? The rate was nothing but 10%. So how do you find the future value? Future value is nothing but present value into 1 plus r raised to n, where n is nothing but the number of years. So 100 into 1 plus r, so 1.1, because 10%, so 1 plus 0.1 raised to 2, effectively square. So 100 into 1.21, which is 121, is your future value. So the formula for future value is nothing but present value into 1 plus r raised to n. Okay, and hence there is multi-year compounding. The same way there is multi-year compounding also. By the way, one fun fact is, if you are at 1 today, 1 year later, if you compound that same 1, what will you be at? You will be at 1. But if you add just 1% effort every day and you compound it for a year, it will be 37 plus. But if you become a lower version of yourself every day and you do this for 365 days, you will be reduced to 0.02 of what you are today. Just imagine the impact of compounding. So quickly going to the next one, which is discounting and present value. See, I told you that the journey, think of compounding as a time machine where you go from today to future. But what if I want to come from future to today? I also need a time machine there. That journey from 121 to 100 is called discounting. That journey is called discounting. So discounting is the reverse of compounding, where you find out present value. What is the formula of future value? Future value was present value into 1 plus r raised to 10. So present value is nothing but reverse of that, future value divided by 1 plus r raised to n. Okay. And hence, if you discount, it is nothing but, let's say if I was to discount it by 10%, but for 1 year, I will say 1 divided by 1.1. So 0.909. This 0.909 is nothing but discounting factor. So future value into discounting factor is also the present value. So the value of 1 rupee in a year from now will be 1 into 9.909, which is nothing but 0.909 today. Okay, so this is called as discounted factor. And remember, higher discounting rate will mean smaller present values. Why? Because if you see, this discounting rate is in denominator. The higher the discounting rate, the lower the present value, because there will be an inverse relationship between present value and the discounting rate. What is the discounting rate, sir? What is the rate at which I should evaluate my investment? That rate is nothing but the cost of capital, which is, in simple words, while there is a separate section and separate chapter to that, in simple words, cost of capital means the cost at which, or let's say the returns that your capital providers, whether debt or equity, what is the return that they are expecting from you? That return is called as the discount rate. That return is called the required rate or hurdle rate or the cost of capital. Logically think, if you are wanting 10% return, then you will have to discount at least 10%, and then if you still have more profits, it means that you are making more profits than the 10%. But if you are not making profits at 10%, then, and you're making losses, then of course your benefits are lesser than your cost, and you will not undertake the investment. This is exactly what the net present value tells you. It says that whatever your cash flows of a project are, you simply discount it at the cost of capital, which is your discounting rate. And then if you are making more profits, if your answer is positive, so let's say in the same example that I told you earlier, I invest 100k today, and I get 25k in a year's time, 50k in a second year, third year I get 30k, fourth year I get 40k. Okay, now one will say, sir, 75 plus 30, 105 plus 40, sir, you will get 145k, sir, you are getting 45k profit. But what if I discount it at 20% cost of capital? Am I still making profit? Maybe yes, maybe no. So I will discount all of these. I will discount this by 1.2 because 1 year. I will discount 50,000 by 1.2 square because this is second year. 30,000 by 1.2 cube, which is third year, and 40,000 by 1.2 raised to 4 because fourth year. And then whatever the answer is, I will add all of these. I will add all of these future cash flows, and I will subtract the 100k that I have invested. If the answer is positive, which means I am making profits in present value term, and if I'm making extra profits over my cost, and hence if my NPV is positive, then I should accept. But what if, sir, this is 0? Then yes, you are not making more profits, but you are earning the 10% that your investors wanted you to earn. So it's still okay, you can go ahead. But if you don't want to go ahead, you don't go ahead. You are at least making the 10% that your investors wanted to. But what if this answer is negative? If the answer is negative, then you are not earning as much of money as your investors want to. You are earning lesser money, and hence you should reject the investment. Okay. Now, what happens if there are multiple projects? If there are multiple projects, then in that case you go for the project which has the highest NPV, which is making the highest profits in relative terms. Okay. So in this scenario, cash flows are given, cost of capital is given. What will you do? You will say 6,000 divided by 1.06. Here you will say 10,000 divided by 1.06 square. Here you will say 8,000 divided by 1.06 square cube, and then finally you will say 7,000 divided by 1.06 raised to 4. You will add all of these 4, and then you will subtract 25,000. If the answer is positive, then you should accept it. If the answer is negative, then you should reject the investment. Remember, in exam it is absolutely important to write a conclusion after you have solved the question. Okay, and now sir you will say, oh, section C sir, I will have the benefit of a spreadsheet. Yes, you will have the benefit of a spreadsheet. You don't have to do this calculation manually. You simply apply a formula of NPV, all future cash flows, so first of all NPV comma what is the cost of capital, so let's say 6% in this example. Then you just select all future cash flows, you select all the cells with the future cash flows, will give you the present value of all the future cash flows. Then you reduce your initial investment, which is 25,000 over here. That spreadsheet will give you the answer. You don't have to do this calculation manually. You just have to type equal to NPV bracket cost of capital comma select all the years, select all the future cash flows, and then subtract the initial cash flow. Okay, that will give you your NPV. So sir, what are the advantages and disadvantages? The main advantage of NPV is, which is the disadvantage of ROCE and payback, which it considers the time value of money, which ROCE and payback period used to not consider. Another problem with ROCE, if you remember, it did not consider the absolute gain. It just considered the percentage. It did not consider the relative scales. NPV considers the absolute gain because it would tell you what is the extra profit over the cost of capital in dollar terms, in rupee terms, and it is based on cash flows. It is not based on the subjective profits. It is based on facts. What is another problem with payback period? Another problem with payback period was it did not consider the entire project life. It just said when do I get my money back? It would ignore all the cash flows beyond the payback period. But NPV will consider the entire project life. And finally, the main motive of a CFO, of a finance manager, is to maximize the wealth of shareholders, which is something that the NPV exactly does. It focuses on maximizing the value of shareholders. One may ask why. It will talk about how much extra profit can I give to my investors over and above the amount that they have invested, and over and above the return that they were expecting. So it helps in maximizing the shareholder wealth. The disadvantages, though, the calculation might be slightly difficult. The calculations might be slightly complex. You have to apply 1.06 raised to 2 raised to 3, so on and so forth. Second thing is you need the exact cost of capital, but sir, it is given in the question. Yes, in exam it is given in the question, but in real life you have to actually calculate the cost of capital yourself. And in fact, in exam also, if you go for the cost of capital chapter, you will have to calculate cost of capital yourself, and it is not the easiest. It involves approximations, it involves assumptions, which means even with a slight change, if 6% becomes 6.2, what if my positive value becomes negative? In that case, you will have to reject the investment. So even small errors can change decisions. NPV is difficult to explain to non-financial managers. See, return on capital employed is very intuitive, that oh, I am earning 10% return. But NPV is difficult to explain to people who've not studied financial management. Finally, it assumes that the cost of capital is known, but in practice, always cost of capital is estimated. It is absolutely never certain in the real life. Next concept, very quickly. Annuities. Let's say you invest in a bond, and that bond tells you that from today, starting today, till perpetuity, forever, indefinitely, infinitely, I will give you 1,000 rupees every year. Actually, that is the concept of perpetuity. That is the concept of perpetuity, which is, we'll come to annuities a bit later. If indefinitely I am going to give you an amount. If forever I am going to give you an amount, then in that case, that concept is perpetuity. How do you calculate the present value in case of perpetuity? Because if you remember the formula, present value is future value divided by 1 plus r raised to n. So I need to know the time period, I need to know the number of years. But in case of perpetuity, I will keep getting the money forever. What do I do then? In that case, what I will do is simply future value divided by r. The formula for perpetuity, the present value in case of perpetuity is future value divided by the discounted rate of return. So let's say 1000 if I am getting, and if my rate is 10%, then 1000 divided by 10%, 100,000. 100,000 is the present value. This is perpetuity. Now let's come to annuity. Now let's say if you are investing in a project, one option is the project gives you 25k in 1 year, 50k in another year, 30k in the third year. The third project will give you 30,000 constant for 3 years. Then how do you calculate the present value? You will simply say, see, option 1 was for you to say, okay sir, I will do as you had told me, 30,000 divided by, let's say, 10%, so 1.1 raised to 1, plus second year I will do 30,000 divided by 1.1 raised to 2, plus sir, third year I will do 30,000 divided by 1.1 raised to 3. But there is an easier way to do this. What is the easier way? You will multiply the annual cash flow. If the annual cash flow is constant throughout the project life, throughout the period of the project, then that number is called annuity. That number is called annuity into annuity factor. Sir, what is annuity factor? It is nothing but an addition of all the discounting factors. Remember, I had explained you the concept of discounting factor here, 0.909. Similarly, for second year that would have been 8.5, third year or whatever 8.6, third year it would have been 7.5. So or whatever, every year there will be a particular discounting factor. For all the 3 years, if I add the discounting factor, that becomes my annuity factor. So sir, how do I do this very quickly in the examination? What you have to do is you have to go to something called as an annuity factor, annuity table. What is an annuity table? Somewhere where all the annuity factors are already plotted. In our example, what is the discount rate? Sir, discount rate is 10%. What is the time period? It is, sir, 3 years. So 10% for 3 years means 2.487. So you simply have to multiply 30,000 into 2.487. This number will give you your present value. And you also have something called as a present value table, where this 0.909, 826, 751 is available. The addition, if you do the addition of these three, this is nothing but the annuity factor, which is 2.48, whatever the number was, 2.487. This is the addition of these three numbers. So in exam, you can simply look at the discount rate, you can look at the time period, but remember what are you finding? Are you finding the present value table or annuity factor table? If you have to go for year by year, if you want to multiply, you will multiply first year 30,000 into 9.909, second year this, third year this, you will have to multiply and then add respectively. But if it is an annual cash flows which is the same, you can simply multiply it by this number. Okay. So in exam, you will be given the present value and annuity tables, which will make it easier for you to calculate. Excuse me. So we've studied thus far the concept of annuities as well as perpetuities. Now, one thing that I will tell you is, when we always talk about present value, we will always assume, both in case of perpetuities as well as annuities, that the payments, either cash inflows or outflows, start from year 1 to whatever year n, or indefinitely then perpetuity. It starts from year 1. But what if it was to start from year 0? Then in that case, at least for perpetuity, what was the formula for perpetuity? the formula was present value is equal to future value divided by R. But this future value, this annual future value of year one is, so there will be some value that I will calculate here, but there is an additional value of year 0 also. So in case of the value starting at year 1, I will say where the future value divided by R plus 1 which is plus the future value plus the amount itself plus the annual cash flow itself. I would say the cash flow itself. So this cash flow, let me put it this way, the cash flow divided by, so let's say 1000 in my example, 1000 divided by 10%, you will say 1000 divided by 10% plus 1000 because you are getting some amount today itself, so you'll have to add that number. Okay, you'll have to add that number where the payment starts. Now in case of annuity factor, what did I tell you? I told you present value is equal to future value into annuity factor. But again, this annuity factor, remember our example, we said year 1, year 2, year 3, what if the payment starts today? You will then say, okay, in that case, sir, I will consider year 1, year 2 and year 0. So I have to do the discounting only for 2 years. If I have to do the discounting only for 2 years, I have to look at the annuity factor only for 2 years. And then simply for this year, the value of 1 rupee today is 1 rupee. So annuity factor for 2 years plus 1. So in case of advanced annuities, where the payment starts today, where the first payment starts today, then in that case what happens is you have to find the annuity for n-1, which I told you for 2 years in our example, and then you simply add 1 to the annuity factor into the payment. Okay, what if your payment starts later? Let's say your payment starts in year 3, nothing in year 0, year 1 excuse me, year 1 and year 2. Then what do? You will say, okay sir, what I will do is I will calculate the value at year 2, assuming the payment starts in year 3. I will use, let's say, year 3, year 4 and year 5, 3 years. 3 years I am receiving the payments. Then I will consider the annuity factor for 3 years. When do I do this calculation? I do this calculation in year 2 for next 3 years. I assume that year 2 is year 0 and I do this calculation for next 3 years. But remember, this value that I get is as of year 2. So now I will have to discount whatever value I get, I will have to discount it to year 0. So step 1 is to calculate PV as if it is a standard annuity. So you have to assume year 2 is your year 0 and you have to do that calculation, and then you have to find out, you have to discount that value to T0, to time 0. Okay, assuming this is clear. Kindly excuse me, not been keeping well, and in fact that is the reason the revision was delayed from yesterday to today. But I know that a lot of you were waiting for this revision, and I know how much this can help you in the examination, which is why I thought it is pertinent on my part to definitely bring this revision. So, but you'll have to slightly excuse me for the hiccups in between. But having said that, I hope this is still helpful. The next discounted cash flow technique is the internal rate of return. What is the internal rate of return? The best way to understand this is one way is what is the return that you had expected, which is your cost of capital. But what is the actual return that the project gives you? That is the internal rate of return, the rate at which NPV is 0. Remember, when is NPV 0? NPV is 0 when you are not making any extra profits. When you are not making any extra profits, which means you are making profits equal to the discounted rate, which means again, if you are making profits equal to the discounted rate, the rate where you are making profits equal to the discounted rate, that rate is the actual rate that you are earning on the investment. So that rate is the internal rate of return. So when NPV is 0, where the discounting at IRR, the discounting is at IRR. Now, how do you decide if you want to make an investment or not? How do you decide if you want to make an investment or not? if, simply speaking, if your actual return is more than your cost of capital, which means you've earned extra profit, then in that case you should invest. If it is equal to cost of capital, you've not earned extra profit, but you earned what your investors wanted. So you can decide, you are indifferent, you may or may not invest. But if you've earned lesser than your cost of capital, then you have absolutely earned lower than what your investors wanted. So you will reject the investment. So if your IRR is more than cost of capital, accept. If your IRR is equal to cost of capital, then you break even. If your IRR is lower than cost of capital, then you have to reject. Okay. Now, how do you calculate IRR? By the way, in exam, especially for section C questions, it is very easy to calculate. Why? Just like you have an NPV formula, you have a formula where you do IRR. Now NPV, by the way, you would consider only future cash flows. For IRR, you have to select all cash flows. Just put all cash flows, and the answer will give you the exact rate will be the answer. So this is when you calculate using a spreadsheet. Okay, but what if you're not calculating using a spreadsheet? Then the simplest way is, again, what is IRR? IRR is the rate at which NPV is 0. So there will be two rates. Let's say at one rate, let's say 10%, at 10% you have a negative NPV. At 10% you have a negative NPV of, let's say, 2000, hypothetically, negative 2000. At 8% you have a positive NPV of, let's say, 5000, hypothetically speaking. Okay, then what is the rate? See, the rate is somewhere in between 8 to 10%, where your NPV is 0. You need to find out what is the rate where NPV is 0. What is that rate? That rate question mark. So simple ratio formulae where you will say, what is my lower rate? My lower rate is 8% plus. What is the NPV at my lower rate? My NPV at the lower rate is 5000, divided by what is the NPV at the lower rate? 5000 minus the NPV at the lower rate, but over here your NPV at the higher rate, but your higher rate NPV is negative 2000. So minus eventually becomes plus, into higher rate minus lower rate, which is 10 minus 8%, so 2%. Once you solve this, you will get the IRR. This is nothing but linear interpolation method of finding IRR, which is you use two different rates, you calculate NPV at two different rates, and then you find out what is the rate where your NPV will be 0. Okay. Now calculating IRR for special cases. Let's say if the annual cash flow is constant, every year it remains the same, which is annuities. Then in that case, how do you find it? The answer is an absolutely easy answer. You will say, okay sir, what if I am investing 100k and I'm getting 30k for 4 years, or let's say 30k for 5 years. So I will be getting 30k for 5 years. What is actually the formula of, what is the formula? Present value is equal to, in case of annuities, future value, or I would say annual cash flows into annuity factor, correct? So I will have to find out what is my annuity factor. So my present value divided by cash flow, I'll have to find out, say in my example, 100,000 divided by, I'm getting 30,000, which means 3.33. What will I do? I will go to the annuity factor table. And I will say, for 4 years, or let's say for 5 years, I am getting 30,000. So for 5 years, what is the rate that I should discount that is closest to 3.33 annuity factor? Okay, at 10% is not there. Let's look at discounting rate 11 to 20% annuity factor. For 5 years, 3.33 closest is this. And hence the answer is somewhere in the middle, more like 15%. Maybe the answer is 15.1 or 15.2%. That might be your IRR. So in case of your annual cash flows, the simplest way is you find out the annuity factor and then you look at the annuity table. The column in which it appears shows the IRR, just like we saw 15%. Okay. What if it is a perpetual cash flow? Perpetual cash flow, what is the formula of perpetual cash flow? Present value is equal to future cash flow divided by the rate. Now if your rate was to be IRR, future cash flow divided by present value is your rate. So if your future cash flow is 1000 and your present value is 100k, then 1000 divided by 100k, which is 1%, will be your IRR. Or let's say if this was to be 10,000, then 10,000 divided by 100k will be 10%. So 10% will be your IRR. Okay, 10% will be your IRR. So that is your perpetual cash flow, which is annual inflow, which is 10,000 divided by the initial investment of 100,000 will give you your IRR. Okay, in spreadsheet, however, like I told you, it's a very simple formula of is equal to IRR bracket values. That is how you calculate in the spreadsheet. Now the advantages and disadvantages of IRR. The biggest advantage of IRR is that it considers the time value of money. That is absolutely the biggest advantage. Number two, it is expressed as percentage, which is easily understood. Again, similar point as return on capital employed. It is easier to say that I am earning 10% return. It is easier to say that I am earning 15% return. It is very intuitive. NPV is not very intuitive. It is difficult to explain, but IRR is very easy to understand. It uses cash flows, not profits. We've discussed this, that profits are subjective. It considers the whole project life. We've discussed this. Payback period had this shortfall. It did shortcoming. It did not consider the entire project life. And finally, it supports shareholder wealth. Then what are the problems with IRR? The problem is it is again not an absolute measure of gain. The same problem that the Rossi method had. What if someone says I am earning 100% return but only on $100? Another person says I'm earning 10% return, 10% IRR, but I'm earning that number on 100k, 1 lakh. I'm earning 10%. What is better? Option 2 is better, but unfortunately IRR does not consider that. So not an absolute measure of profitability. Second is, if you don't have spreadsheet, if you have to manually do the math, interpolation estimates can be inaccurate. You can get incorrect number. Number 3, like you said, calculation is complex. It is not very easy because when discounting comes into picture, it becomes a more difficult calculation. Number 4, you can expect a lot of MCQs around this, which is when there are non-conventional cash flows. See, what are conventional cash flows? Conventional cash flows is when year 0 you invest in a project and in year 1 you receive, year 2 you receive, year 3 you receive. But what if you are investing in a machinery, or let's say there's a license which you will have to keep reviewing in respective time periods. So there will be some outflow every 5 years or every 2 years, and then in the middle years there will be some inflow. In that case, there could be either no IRR or there could be also multiple IRRs, in which case even the spreadsheet function may fail. Last two things are that it is an assumption that, let's say if you are investing at a 15% IRR for 5 years, it will assume that your year 1, year 2 cash flows are reinvested at 15% from year 1 to year 5. This cash flow of year 1 is reinvested at IRR. But let's say you found a great project which is giving you 25% return, but now once your funds are released in year 1, to some extent you do not get another project that is giving you 15%. You will say, okay, I will invest in probably a bank which is giving me 10% return, but IRR actually assumes that you are reinvesting from year 1 to year 5 at the rate of return. it assumes the reinvestment rate at project IRR, which is not always the case. And finally, it cannot compare mutually exclusive projects reliably. The same example that I gave, sometimes higher IRR project, which is 100% return, but on lower amount, it has lower NPV, while a lower IRR project might have higher NPV. So it may lead to wrong decision making. So what do you do with these problems? What should you do whenever you have to choose between two different projects? Always look at NPV, because what is your ultimate goal? Your ultimate goal is to maximize the wealth of your shareholders. How do you maximize your wealth of the shareholders? The only way you maximize that wealth is by looking at NPV, because that talks about the extra wealth that is generated. So you can look at the example also. Your lower IRR but higher NPV, 500k, higher IRR 18% but lower NPV. So in the first project, it is generating extra profit of 500k. Second project is generating extra profit of only 300k. What is your purpose? Your purpose is to maximize the wealth of your shareholders, and hence you want to maximize it by 500 and not 300. You will go for option 1 and not option 2. So always go for NPV, not IRR. Why is NPV superior? Because it shows the absolute increase in shareholder wealth. NPV respects the company's cost of capital. It does not have the reinvestment problem. And finally, IRR can mislead on scale issues. The same example of 100 versus 100k that I gave to you. Okay. But when both agree, when will both agree? They will both agree if it is simple cash flows, if it is a simple accept reject decision, and the projects are independent. It is not a question of either or, it is a question of whether you should undertake a particular project or not. Okay. Now, excuse me, I will let you pause and I will let you read all the common mistakes that people make in these questions, overall the summary of this chapter, as well as some exam tips that are there. So you might want to pause your screen, look at this, and right after, let us go for a quick, only 5-minute break, because we do not have a lot of time. Let us go for a quick 5-minute break, after which we will start with the next chapter. Okay. The timer will show 10 minutes, but we will start only and only in 5 minutes. Okay. Hello, welcome back after a very quick break. So, on to the next chapter, which is the further aspects. What if there is inflation in the question? What if there is tax rate in the question? What if there is working capital in the question? How do you solve that? First of all, starting with inflation. The way I have always explained this concept is that, and I'm sure I don't need to explain the concept of inflation, but what is the relationship between real interest rate and nominal interest rate? See, let's assume you have a burger where the base bun is 1. The patty is the inflation. So you will of course want to get compensated for the inflation when you invest in something, but you also need a cheese on the top, which is that extra return, which is the real return that you need. That burger will be the nominal rate of return, which is the total return that you want. So 1 plus the nominal return, which is the money return or the nominal return that you need, is nothing but 1 plus real return, which is the cheese, into 1 plus inflation, which is nothing but the patty. So that is the relationship between the nominal rate and the money rate. An example is given: if you require a 10% and inflation is 5%, then you need 5% also, you need 10% also. So do you need 15%? No, you don't need 15%. You need 100 into 1.05, 105 for inflation. Then you also need 10% on top of it. So you need total 15.5%. How do you calculate this? You will say 1.05 into 1.10. This is the total number that you need, which comes to 1.155, which is nothing but 15.5% return if you subtract 1. Okay, so that is your concept of nominal and real return. Now, how is it useful in the examination? See, what happens in the examination, there could be cash flows given, which are given. Let's say your sale price is $5. If the cash flow is given at today's prices, which means that inflation has not been accounted for, you will have to add inflation for your year 1, year 2, year 3 cash flows. But if the question says that it is nominal cash flows, then it already accounts for your inflation. Okay, so if the question says that it is in current or today's prices, then cash flows are stated without an inflation adjustment. If it says that it is nominal, it is adjusted for expected inflation, then it is nominal or money cash flows. And then what are real cash flows? See, there's a difference between current cash flows and real cash flows. I'll explain you why. Okay, here is where the concept of general versus specific inflation comes into picture. Let's assume you are staying at a hostel. Okay, you buy pizzas, you travel by a bus. Okay, you spend 50 per day on each of these. Very hypothetical example. Let's assume 1 year later the hostel increases its prices, its rent or whatever it's called, by 5%. Pizzas increase by 10%, but bus is subsidized. There is 0% inflation over here. Overall economic inflation is, let's say, 4%. Excuse me. Then you will have to, these 3 inflations are nothing but the specific inflations that apply to the specific categories, but this 4% is the general inflation. So now, if you want to find out what is the real cash flow for all of this, you'll have to first add the specific inflation, and then you have to remove the impact of the generic inflation. Only then you'll be able to find out the real cash flows. So there are 2 types: general inflation, which affects the overall required rate of return. In the formula, the burger formula, you'll have to consider the general inflation rate, but when you are giving specific items, for example, wages inflate at 3% and materials at 4%, you'll have to inflate it at the respective values. Typical scenario where your goods are more expensive but your salary does not increase as much. So if you are given current cash flows, you are given cash flows in today's prices, you will have to increase with the specific inflation. Your cash flows are 50 50 50, which is at current cash flows, today's prices. You have to find year one cash flows. You will add the specific inflation rates, and then once you found out the money cash flows, to deflate it to real cash flows, remove the impact of inflation, you will do so through the general inflation rate of 4%. Okay, here's an example also given, you can quickly read it. Okay, now there are two methods in examination. There are two methods of handling. By the way, I want you to read each of these illustrations, very important. In exam, if it is mentioned that sales of 100 in current terms, then excuse me, the 100 is in today's prices and you have to inflate it by 10% for next 3 years. So year 1 will be 110, year 2 will be 121, year 3 will be 133. But excuse me, if you've been given then 100 will be in year 1 excuse me, I'm sorry, then the inflation of year 1 has already been accounted for. You just need to apply the inflation for the next 2 years. These will give different results. Read the questions carefully. It is a common mistake that most students end up making in the examination. Now, which method do you apply in the exam? The simplest suggestion that I have for you is try to apply money method every time. Try to convert all cash flows into money cash flows and then try to discount using the money cash flow rate in examination, always, to avoid any mistake. But if you know that all the cash flows are given in real terms, I have something called as the RRMM approach, which is the cash flows are in real terms. Use the real discount rate to do the discounting. If the cash flows are in money terms, then you use the money cash flow rate. But the caveat is there should be no taxation. If the question has taxation, or if the question has multiple inflation rates, if there is a specific inflation rate in the question, always prefer money method. If there is tax in the question, always prefer money method. My personal suggestion to you is to avoid any confusion, to avoid any risk, always prefer the money method only. Okay. Now, an example of generic and specific inflation rate. You have been given wage cost in real terms. You have been given in real terms. So you will have to increase it by this number every year. And then you have to discount all cash flows using money cost of capital. How will you find money cost of capital? You've been given the real cost of capital. You've been given the general inflation. You will simply do 1.085 into 1.06. Whatever the number is 1 plus I. You have to find out I, which is the money cost of capital. You find out the money cash flows and then you discount using the money cost of capital. Okay, very clear. Now, what if you have tax in the question? What if you have tax in the question? How do you deal with taxation? First of all, what is tax? Tax is you get operating inflows, you get profits every year, correct? What do you do with that? You'll have to pay tax on it. Will you pay tax on it today itself? Yes, theoretically possible. Realistically, generally speaking, you will pay the next year when you file your income tax return. So the standard assumption is you will pay tax in 1 year's time. Now, why is tax important? You earn 100 rupees. Let's say the tax rate is 30. You will have to give 30 to the government. And is that 30 a relevant cash flow? The answer is yes, it is a relevant cash flow because it is incremental. It is future cash flow in nature. So you have to consider it as a cash outflow. Okay. When do you have to consider it? Unless anything otherwise mentioned in the question, always assume that tax is paid after 1 year. Okay. And always assume that company has sufficient tax profits available, which means if there is a loss in a particular year, you will have to you will have to assume, unless mentioned otherwise, you will have to assume that there will be a cash inflow. There is a cash inflow for that particular year. Just like there is a cash outflow of taxation when there is a law, then there is a profit, there will be a cash inflow. Assume that the government will pay you some money if you are making loss, hypothetically, of course. So because what happens in real life, you will be offsetting your loss against other profits of the company. So on the other profits, the company will have to pay lesser taxation, which effectively means that the company has saved some cash flow, which means there is a cash inflow. Then there is a concept of tax allowable depreciation, absolutely important from an exam perspective. Assume this will definitely be asked in exam, both from a section A perspective as well as a section C perspective. What is tax allowable depreciation? Sir, you told us that depreciation is not a relevant cash flow. Yes, I agree, depreciation is not a relevant cash flow, but there is a tax saving on depreciation. Remember that depreciation, while it is an expense, it is allowable from an income tax perspective. It is allowable, and hence if you are making that expense, you will be saving some tax. This tax that you are saving is a relevant cash flow. The depreciation is not a relevant cash flow, but the tax that you are saving is a relevant cash flow. Okay, so it is calculated as a percentage of the written down value. Method is either reducing balance or straight line. What is this? This is depreciation. How do you calculate depreciation? Generally on written down value from an income tax perspective, mostly reducing balance method. Over the asset's total life, your total tax relief, the total depreciation will be on the cost of the asset minus the scrap value. This is the total depreciation, and when you put a percentage of taxation to this, that is the amount of tax. Is the tax allowable depreciation relevant cash flow? No. Only the tax on the tax allowable depreciation is a relevant cash flow. And then, so every year you will get the benefit of taxation on the depreciation except the year of disposal. Why? In the year where you are scrapping the asset, when you are selling the asset, there is a concept of balancing allowance or balancing charge. I'll give you an example. Let's say, for the sake of simplicity, you had an asset of 100K. Annual depreciation was 20,000 for 5 years. There was no scrap value, or let's say the scrap value was 10,000, or let's say the scrap value was, let's say 20,000, and out of the 80,000, you were using it for 5 years, so 16,000 was the annual depreciation. You used it for 3 years. So year 1 depreciation 16,000, year 2 depreciation 16,000, year 3 depreciation 16,000. At the end of year 4, you used it in year 4 also, but at the end of year 4, you are going to sell it for scrap. Okay. Now, what is the written down value at the end of year 3 or beginning of year 4? So this is 48, 100 minus 48 is going to be 52,000. You have sold it for 60,000. Wow. You made profit versus what you had thought. You made an extra profit. If you make a profit versus what the written down value is, then on that 8,000 pay tax. If you pay tax, this means there is a balancing charge, which means you have to pay tax. But what if you had to sell it only for 40,000? Then there is another loss of 12,000 that you had to incur. If you had to incur a loss, then there's 12,000. You will save tax because this is again allowable for you. So the original cost minus cumulative depreciation till date, but till date means beginning of the year when you have sold, which is end of last year. What is the written down value? So you will find out that number less disposal proceeds. This number is written down value, okay, less the disposal proceeds. Disposal proceeds was 40K, and hence the 12K if positive will be balancing allowance, which is you will get a tax benefit, you will save tax. And if there is a tax benefit means you will assume you are getting money. Tax benefit means you assume you are getting money, which means it is a cash inflow. But if it was a balancing charge, which is if you are making profit, then you'll have to pay tax. In this case, if you save tax, which means there is an inflow of money. So balancing allowance happens when WDV is greater than proceeds. When you excuse, please excuse. Sorry, please excuse me. Excuse me. So if your WDV is greater than your proceeds, which means you had a higher value but you realized a lower value, so there was a higher loss. Let's take a break of a couple of minutes. Sorry for that, but thanks for bearing with me. So balancing allowance is if your written down value was higher than your proceeds, which means if you are selling it for lower than what you had the value in your books, then there will be an additional loss, and there is an additional loss, then in that case there will be a tax benefit. It reduces your tax, hence there is a cash inflow in that year. The reason I'm really focusing on this concept is it is absolutely important from an exam perspective. Okay, while balancing charge means there is an extra taxable amount which increases your tax and your cash flow in that particular year because you are going to make a profit. Okay, how is your tax relief calculated? Simply tax allowable depreciation amount into the tax rate will be your tax effect. Remember, depreciation is a non-cash expense. It is not a relevant cash flow, and hence depreciation will not be considered. Only the tax effect on depreciation will be considered. Only the tax effect is the relevant cash flow for NPV purposes, not the depreciation in itself. And at the time of disposal, first of all, what is the time? What is the time when you purchase? You purchase it at year 0. You have to assume, unless otherwise mentioned in the question, you have to assume that you purchase it on the first day of the accounting period, which is year 0. And when you sell it at the last day. Okay. And the depreciation. Does depreciation get impacted immediately? No, sir. I will have to record it after the year gets over. So the depreciation starts getting recorded in T1. Now, what if the tax is delayed by 1 year? Then on the tax allowable depreciation of T1, my tax benefit, my tax relief will flow into T2. Okay. I may not be able to share these notes while I will try, but maybe you can take screenshots and quickly read through. So if the appraisal period is set at 4 years, but the tax is paid in arrears, the actual cash flows cover 5 time periods, because your tax benefit on the 4th year depreciation or the balancing allowance of the 4th year, the benefit will actually flow through in year 5. Okay. Now finally, if there is working capital in the business, what do you do? In the year in which you start your business, which is year 0, there is working capital. Let's say you invest 100,000 of working capital in year 0. The cash outflow will go on year 0. What happens? Every year you need a particular amount of working capital. Let's say your business is 3 years. Your business goes on for, let's say 4 years. Your business goes on for 4 years. Okay. You need 100K working capital to start with, and it goes up by 10% per annum. It goes up by 10% per annum. Okay. What happens then? In that scenario, what happens is, you will say, what is your year 1 requirement? Your year 1 requirement is 100K. This is requirement, not cash flows. This is requirement. Year 2 will be 110K, year 3 will be 121K, and year 4 will be 133K. Okay, 132 point something, 133K approximately. But remember, your cash flows will always go on the beginning of the year. I will have to invest in the beginning of the year to make that inventory, to make that sales. Okay. So my cash flow will always go 1 year in advance. I will invest 100K at the start of year 1. At start of year 1 means year 0. How much incremental do I need? 110. What is the incremental? Do I need 110 in second year? Yes, but I already have 100K in the business. So I need only 10K extra in year 1. Year 1, end of year 1 for year 2, then another 11K, end of year 2 for year 3, then another 12K, end of year 3 for year 4. But at the end of year 4, I close down the business or the project. I will get back all the amount that I had invested. I had invested 100 plus 10 plus 11 plus 11K plus 12K. So I had invested 133. The entire 133 I will get back at the end of year 4. So initial investment cash outflow will be at the start of the project T0. Then it increases during the project. There are cash outflows, which is additional investment is required during the project, which is this. It also can decrease. If it decreases, then there is a cash release in that particular year, and at the end of the project, all the remaining working capital is released as a cash flow. So this is cash inflow at the end of year 4. Okay, there is an example that is given. You can take a look at the example. Okay, when the question includes both working capital and inflation, you have to use money method. You inflate the amount of sales. You inflate the actual money value of the base. If let's say working capital was 10% of sales, you calculate sales for every year. Then what you do is, you apply 10% on that number. You will find the working capital, and then once you find working capital, and then you find cash flows, because year 2 working capital will go in year 1. But there's some amount that is already gone in year 0. So year 1, the amount that goes is nothing but year 2 working capital minus year 1 working capital. Okay. Apply the fixed percentage, and then you make the incremental changes from the base. So finally, if there are big questions that are asked in the exam, and you can expect that big questions will be asked in section C from an investment appraisal perspective, what do? You will say, what should I do? I will, by the way, this is the hero, villain, and side character. You have to always remember hero, villain, and side character. Who is your hero? Your net operating cash flows, your net profits of every year. Let me put it this way, not net profits, but your cash flows. Let's say depreciation is not a cash flow. So your net profits, which are in cash, will be your hero. What is your villain? Your villain is going to be the tax that you pay. Who are your side characters? Your side characters. Now side characters will be 2. Side characters will be 2. There is a second hero also. There is a second hero and there is another side character. The second hero is who? Who comes to your rescue? Who comes to your rescue? There is going to be a tax benefit. There is going to be a tax benefit on the, there is going to be a tax benefit of the depreciation, tax allowable depreciation. And finally, another side character who keeps changing colors but finally has net zero impact is working capital, because you will invest but that amount in the last year will be released completely. You will, in fact, the sign will be positive. There will be a positive number in the last year. Everything will get released. So in exams, this is the format that you need to follow. Instead of writing year 1, year 2, year 3 in rows, you should write it in columns: year 1, year 2, year 3. From a presentation perspective, this is very important. The cash flows in respective years, remember to inflate. Do not forget to inflate. Use specific inflation. If there is given, if there is separate for wages, separate for sales, please calculate separately and then do the calculation. Don't directly apply. Then you have to calculate the tax. If the same year, then year 1 will be year 1 here. But if it is delayed, then year 1 cash tax will be year 2. Year 2 will be year 3 and year 3 tax will go in year 4. Initial investment always goes in year 0. There is a scrap value also. If you sell an asset, whenever you sell, you will realize that value. Depreciation, again, tax relief. If tax is delayed, then year 1, year 2, year 2 cash depreciation relief, year 3 in year 3, year 3 release in year 4, and finally, actually year 3, if you would have sold, then depending on whether there is a balancing charge or balancing allowance, it will go in year 4. If it is a balancing allowance, then there is a cash inflow. If it is a balancing charge, then there is a cash outflow. If the tax is delayed, it will go in the next year. And working capital, the second side character, another side character. Always remember, if you have considered all the hero, villain as well as the side character and the residual, I would say second hero. There are 2 second heroes. There is scrap value and there is tax release, because both are a cash inflow. Both come to your rescue in the year 3. Another side character, of course, comes to your rescue in the 3rd year, but in the first 2 years as well as the start of the business, you'll have to keep investing. Then what you do is you total all of these. You'll find the net cash flows and then you multiply it by the discounting factor of the respective year, which will give you the present value. And once you sum all the present values, the sum of all present values, including the cash outflow of first year, will give you your NPV. In examination, remember, for NPV, you use the formula NPV bracket R, which is the discounting rate, all future cash flows minus outflow in year 0. Okay, this is how you can calculate using your spreadsheet. Here are some best practices. Always use money method when tax is involved. Inflate revenues and costs separately at the specific rates. Inflate cost and disposal values also before calculating the tax allowable depreciation and balancing charge or allowance. Calculate working capital on inflated figures. This is a common mistake that people made. Do not forget. Put working capital in the right year. It is generally at the beginning of the same year, which means the end of the previous year. Tax always will be delayed unless otherwise mentioned. Do not make this mistake. And in the question, if it is a pre-tax real rate written, always consider a post-tax discount rate, because there is a benefit of taxation that you always get. Okay, there's always a benefit of taxation that you get. I will let you quickly read or take a screenshot of the key formulas and the common mistakes that most students make. This is picked up from the examiner's comments. Quickly read. Like I told you, investment appraisals is absolutely important from an exam perspective. So please try to solve as many questions as possible ahead of the exam. Try to read through all the common mistakes that people generally make in the examination and try not to repeat those mistakes. I would say that's it for today's session. We will continue this session tomorrow. Of course, we have a couple of more smaller chapters for investment appraisals itself before we move on to the risk management chapter, which is another important chapter from an exam perspective. So I will say just come back at 4 p.m. tomorrow. 4 p.m. tomorrow. Tomorrow is 1st March. Tomorrow is 1st March. We will be live on my YouTube channel at 4 p.m. tomorrow, and we will continue from where we have left. 4 p.m. 1st March, Sunday. Please be live and keep preparing. Please solve a lot of questions. Especially from an investment appraisal perspective, but in general also solving questions is super important from an exam perspective. Please try to give mocks as we are only 6 days away from the examination. All the very best. That's it for today. Good night and see you soon. All the best.